Keep this under a minute so it could go to the shorts. It will not let me. There's just too much information. So let me break it down for you. First off, let's go to x.com and we can see Roundhill came out with HOOW, and after the couple months it's been out, it decided to compare it against HOOY. So just for the rest of this video, just know Roundhill is HOOW based off of the Robinhood stock. YieldMax is HOOY, also based off of the Robinhood stock. And both of them are ETFs that pay you. Now, HOOW by Roundhill will pay you every week. YieldMax, HOOY, will pay you every 4 weeks. Now, let's actually look at the dividend math. Don't just go by a graph, right? Because they're going off of that time basis. Neither one of these stocks have even been around for 5 months. Keep that in mind. I want to see the analysis after a year. I want to compare the gains after a year. But we're going to go look at the dividends real quick. I'm going to pause this. Based off of the price you got it for, HOOW did exceptional this week. They paid $1.59 per share for the week. Here you can see, right? Before that, 83 cents. Before that, $1.27. Before that, $1.12. So for the 4 weeks, you would have made $4.81. Depending on how much you invested it for will determine how much you got back, how quickly you're getting paid back. Now let's go over to HOOY YieldMax. Here you can see the last dividend payment, right? The ex-dividend was July 24th. You were paid $6.89. So for 4 weeks, had you let your investment sit and bought 1 share, you would have made $6.89. If you had bought HOOW 4 weeks ago, you would have made $4.81. Now, we're going to compare depreciation, stock going up real quick. 1 second. Here we're on HOOY. You can see it only came out May of 2025. And you can see it's gone up from 50 bucks. When we had the little tariff thing recently, you could have gotten it for 60 something bucks. You know, always be lookout on those announcements because they definitely can dip the price. Now let's go to HOOW, and I'm going to do a side note once we get to the HOOW. Here we're on HOOW. Let's scroll down. Here you're seeing it's paying you every week. It came out in June of 2025. Right? Now overall, if you are just concerned about how much you're getting paid in dividends, I would say overall, HOOY was probably paying you better. HOOW was going up more over time. Like you see, it came out at 50. It's currently at 70 something. So you can usually get the YieldMax HOOY cheaper on the dollar. If you're looking to buy and sell and day trade, which is technically gambling, and I don't recommend it to somebody who doesn't absolutely know what they're doing, you would probably go with HOOW if you want to day trade, make that quick payout. However, keep in mind, these are new ETFs, and I always like to remind you guys, a lot of ETFs perform best their first year, especially if they're good dividend payers. Also, please know HOOW is an inverse 3 times stock. And the dumb way to dumb that down for people that don't know, when the market's doing really good, this one's going to do really good. If the market hits this one hard, it's going to hit a lot harder than it might with HOOY because it is like the 3 times inverse. So be careful, right? Both of these are new. Both of these are things you do not want to dump all your money into. You can look at a lot of ETFs. Just look at TSLY, look at ULTY. When the market had a hard hit, some of those stocks did not recover. When they dipped, they were lucky to see themselves go back up $1 when they lost 8. Right? You guys get the point. You do the math for yourselves, you know? Again, I'm going to show you the dividends. Let me pause this and go back to HOOY to compare the dividends. Okay, here we're back on HOOY. And you can just see it was when you add up all the dividends, HOOY was pretty much, in my opinion, paying better per dollar. Until we see a mini market crash, we won't know how well these stocks really perform. A lot of people are hyped up. They're seeing this quick gain. They might pull an MSTY. I would not personally pick one over the other. I would invest in both of them pretty equally, depending on your strategy, right? We all have different strategies. But just because HOOW is inverse, it will be more sensitive. So when it's up, it's going to be really up. And when it's down, be careful. Same thing with HOOY, though. You guys do the math yourself. Don't just look at their graphs. go by what's your strategy. Are you more of a day trader, or are you more like me where you like to invest one time, let your money sit, pay itself back, and take those dividends and invest in other things? Everybody has different strategies. You do what's best for you guys. You guys have a great day. Happy investing. Do your math.